Every single day, forces you've never heard of are moving your money. The Fed, AI, geopolitics, currency wars. Most people only see the headlines, but they never understand the signal beneath the noise. That's what MacroSignal is for. Meta cut 21,000 jobs. In the same period, the company's productivity increased. Its profits soared. This is not a contradiction. It is the central feature of the economy we now live in. Economists call it a K-shaped economy. One line goes up, one line goes down, and they're describing the same country at the same time. The top 10% of US households now receive about half of all income. They own 62% of household assets. Total household assets stand near 630% of GDP, higher than before the dot-com bust or the 1987 crash. If your portfolio is doing well right now, you are on one line. If your job feels precarious, you are on the other. Today, I explain exactly how this split economy works and what it means for your money either way. Okay, let's dive into this. We're gonna jump straight into a micro event that just perfectly captures our current macroeconomic reality. Back in 2022, right after this massive pandemic-fueled hiring spree, Meta's global headcount peaked at a staggering 87,000 employees. But then, the music stopped. CEO Mark Zuckerberg came out and declared a year of efficiency. The focus abruptly shifted. It became all about canceling projects that were deemed duplicative or just lower priority, and really making the organization as lean as possible so they could execute faster. And the sheer scale of the human cost from the shift is massive, 21,000. Meta ultimately cut roughly 21,000 jobs. But here is the absolute paradox that we really need to unpack today. During the exact same period that they shed tens of thousands of workers, the company's productivity actually increased. Its profits absolutely soared. They didn't just survive the cuts, guys. They thrived because of them. Section 1, the Meta Efficiency Paradox. Doing more with less. Now, you might be thinking this is just a story about one social media company course-correcting, right? But actually, Meta is acting as a perfect microcosm for a much broader economic reality. This paradox of shedding human labor while simultaneously expanding margins, that is the defining feature of the economy we live in right now. Economists call this a K-shaped economy. It's this wild environment where one segment of the economy thrives and shoots upward, while another segment completely declines and faces immense strain. Right now, consumption is heavily supported by those top asset-rich households we mentioned earlier. The top 10% taking half the income and owning 62% of assets. Meanwhile, lower income cohorts and increasingly cognitive workers are feeling the severe everyday strain of a softening, really precarious labor market. It's the same country at the exact same time, but completely different realities. We are literally looking at two totally distinct paths. The line going up, that represents asset-rich households, companies with super durable earnings, and these massive investments in AI infrastructure. But then you look at the line going down. That represents the increasingly fragile state of human cognitive labor, legacy software models, and lower-income cohorts who are just struggling to deal with higher living costs. Both of these conflicting realities exist in tandem. The market is just rapidly reshuffling the winners and the losers. Section 2. AI targets cognitive labor. So what's the structural force actually driving this massive divergence? It's artificial intelligence. But I'm not talking about AI as some futuristic concept. AI has officially crossed from a forward-looking investment thesis into a stark, cold, everyday operating reality. And it is moving with absolutely blistering speed. Think about it. Back in 2020, human developers relied on each other, right? Stack Overflow fielded over 300,000 coding questions a month. Today, that number is effectively zero. By the second half of 2025, agentic compute, which basically means AI systems instructing other AI systems, grew to make up a majority of all total compute. And by 2026, Microsoft reported that a full 35% of its code is now written by artificial intelligence. AI is literally designing better versions of itself, completely wiping out once standard human coding tasks. And hey, it's not just tech companies either. Look at this specific example from Travelers Insurance. They managed to consolidate 4 call centers down to just 2. They cut their real estate and their labor footprint half, while simultaneously doubling their net income. No way, right? But that is AI-driven efficiency in action. It expands margins and creates substantial growth without the need for additional human labor. In fact, it actively requires less of it. Throughout history, technologies like agriculture or shale energy flatten supply curves, for sure. But this cycle is completely unique because it directly targets cognitive labor. To fuel all of this labor substitution, we're witnessing an insane leap in infrastructure spending. Capital expenditure from hyperscalers, the massive data centers powering AI, is jumping from $360 billion in 2025 to an expected $610 billion in 2026. Overall, this is part of a projected $2.2 trillion global AI infrastructure boom by 2028. To put that into perspective, this spending isn't just an expense on a balance sheet. It's a massive capital expenditure boom, a direct substitute for human labor, and a huge margin expander for the companies actually deploying it. Section 3. The Great Market Dispersion, a historic reshuffling. As AI accelerates, gravity has definitely returned to the financial markets, but it's arrived completely sideways. Rather than the whole market crashing or rising together, we're seeing a historic reshuffling. Broad indices like the S&P 500, they look basically flat, but underneath the hood, utter chaos. For the last decade, software and semiconductors traded together. Not anymore. Software equities have plummeted 30%, falling all the way back to 2021 levels. Meanwhile, semiconductors, the hardware actually powering AI, surged 30% to fresh highs. Traditional tech correlations are completely breaking down. This is causing some highly concentrated pain in the software sector. It's a genuine reckoning. Almost 80% of software loans are to private equity-sponsored companies. Over 15% of these were originated during the pandemic boom at peak valuations that simply aren't clearing in today's market. With roughly 30% of these loans maturing by 2028, business models that were built around peak valuation software lending face severe disruption risk, all thanks to the sudden acceleration of AI. Section 4. Geopolitics and sticky inflation. Now, as if this wasn't enough, complicating this incredible tech divergence are immense macroeconomic forces in the Middle East and their direct impact on sticky inflation. It creates a textbook monetary dilemma. First, the conflict escalates. Next, this uncertainty causes crude oil prices to surge. Higher energy prices immediately put upward pressure on headline, near-term inflation. And finally, because inflation is reading hot, the Federal Reserve is forced to delay cutting interest rates. They are totally trapped. They can't fix supply shock inflation with monetary policy, and they're forced to hold rates steady at the exact moment when the broader economy, which remember has shed hundreds of thousands of jobs outside of the healthcare sector, really needs some accommodation. Section 5. The Golden Age of Income. So, how are institutions actually navigating this turbulent landscape? You've got AI disrupting labor, software valuations collapsing, and central banks trapped by geopolitical inflation. Well, they're doing it by focusing heavily on contractual income. First, we have to recognize just how extreme global equity markets have become. The top 10 US stocks now command a market capitalization of $25 trillion. That is literally larger than every single equity market outside the US combined. This historic level of concentration means investors have to fundamentally redefine what they even consider a quality investment today. You can't just blindly buy the market anymore. The whole definition of market quality has been rewritten. Old quality used to mean low earnings variability and high gross profits. Simple, right? But in the age of AI and dispersion, new quality is defined by highly durable earnings and relentless free cash flow growth. Companies that can translate AI into durable cost advantages and cash flow resilience will separate from those that cannot. Roughly 40% of S&P 500 companies don't even clear their cost of capital right now. The winners are separating violently from the losers. So the crucial point is how to actively position for this. According to BlackRock's strategy, the key is to anchor portfolios in diversified, high-quality fixed income, targeting a 6 to 7% income stream. This creates a much-needed margin of safety against geopolitical noise and sticky inflation. You have to navigate this market dispersion with absolute precision. Bottom-up analysis matters way more than top-down sector bets now. You must treat AI as the defining variable of this decade. And finally, only own equity risk where cash flow heavily compounds. Ultimately, the economy is no longer a single story. It's a split reality. Remember, total household assets stand near 630% of GDP, higher than before the dot-com bust or the 1987 crash. If your portfolio is doing well right now, you are on one line of the K. But if your job feels precarious, you are on the other. Which line are you on? If this explainer resonates with what you're seeing in your own life or workplace, subscribe to MacroSignal, drop a comment below, and share it. Keep seeking the signal, and we'll see you next time.